Silver prices have just experienced a short squeeze, driven by a historic change in the way margin requirements for silver contracts are calculated. So let's talk about what's going on. The CME Group have made two announcements, one yesterday and one today. Let's go into the announcement they made today first. So today they announced that they will launch a 100-ounce silver futures contract on February the 9th. Now, this is quite unique because historically, one silver futures contract gives you control of 5,000 ounces of silver. This is a much smaller contract, also known as a micro contract. So one contract will give you control of 100 ounces of silver instead of 5,000 ounces. That is 50 times smaller. So what does that mean? Well, in a nutshell, what it means is that retail traders like you or me, with a lot less money than these big players, can buy futures contracts and participate in this market. You can basically buy or sell silver on margin. You can borrow money you don't have to buy or sell silver. Now, that is pretty interesting, and it can potentially cause increased volatility from February the 9th onwards. However, that's not really the big news. The big news is what was announced yesterday, and that is a historic change in the way the margin requirements are calculated. You see, when you want to buy one silver contract, you currently need to have $32,500 in the account to cover your margin requirements. Now, historically, this has always been a number, and the CME Group don't normally change that number. So if the price of silver went up by 10%, you would still need to have that same number, 32,500, in your account. And this has been the way it's always been. Of course, in the past, the margin requirements were less. So, for example, at the beginning of last year, I think you could have $25,000 in the account to keep that position open. But as of today, or as of yesterday, and in fact right now, you need 32,500. So you can see how you need to add more money to the account just to keep your position open. But here is the big change, because it has never been done before. They're now moving to a percentage-based margin requirement, which means it's going to change or fluctuate daily. This has never been done. So here's what it means in a nutshell. Let's take the current price of around $88 an ounce, which is what silver is hovering around right now, and see how much margin you would need if you want to keep your position open after the close of play today, following this change. All right, well, I've already done the calculation here. What I've done is multiply the price of silver, $88, by 5,000 ounces, because that is how much one contract will allow you to control. And actually, no, I've done it wrong. It's over here. And you multiply it by 9%. That gives you $39,600. So if you had $32,500 in your account, because that was the original or the old margin, by the end of today, you need to add several $1,000s to that account just to keep your account or your position open. Not everyone has that. Now, this is even more interesting because if the price of silver went up to, let's say, $100 an ounce, you now need to ensure your account has $45,000. So you need to add even more money. As the price of silver goes up, you need to add more money to your account, or you will be forced to close out of your position. And that is going to become a huge risk for many traders. Now, what is going to become even riskier is that this change in margin requirements opens the floodgates for a lot worse, because the new margin is 9%. But what if the CME Group decide next week that they're going to increase it to 10%? Well, now let's take a look at what happens. If you increase the margin to 10% and silver remains at $100 an ounce, your margin requirement, instead of being $45,000, would be $50,000. So you would need to add even more money, right? Just because the CME Group made another change. And this is going to, again, cause a lot of investors or a lot of traders to close their positions. Now, why is this causing a squeeze? And what is a short squeeze? Well, let's take a look at what's going on. This is the silver price, and let's take a look at the daily chart. You can see it's been going up like an absolute rocket. Now, if you bought silver, let's say 5 days ago, right? So where are we? 1, 2, 3, 4, 5. Over here. You decided to buy silver over here, and we're talking about contracts. So right now you're in the money because silver prices are higher than where that contract was opened, right? Well, at the end of the day today, the margin requirement on that account will go up, but you're already in the money. So it's not really a problem for you. If you've got the money to keep your account open, then you're most likely going to do it. Now, let's say that you were a short seller. You thought, hang on a minute, I actually think that this is the top, that silver prices are going to go down. And let's say you have a very big, to be fair, you can't really get out of this, in the way that normal traders do. But anyway, let's say that you've got a very big margin, right, of error. And you thought, yep, silver prices are going to go down, but actually, they've gone against you. Well, here's what is going to happen. You've now got to add several $1,000s to that account, and yet you're losing money on that contract. So you have two choices. You can either add to your account to keep your position open, or you can close your position. So most traders in this case are probably going to close their position. Now, what does that mean? It means that by closing your sell position, you're buying back. So now you've got a whole bunch of people being forced to buy back around this region. And of course, that is creating buying pressure, which is why, if I go to the hourly chart, you can see that prices shot up, right? The market open today, prices shot up because all of those positions had to be closed. And those people who were already making money are now potentially making even more money. They're in the money by a bigger position. Moving forward, what does this mean? Well, like you've seen, if the price of silver continues to go up, then those traders will have to add more to their account balances just to keep those positions open. Otherwise, they will be forced to sell. And that is, of course, when you sell, it's going to cause selling pressure or downward pressure on the price of silver. Now, because this margin is dynamic for the first time ever, what it could mean is that silver prices stabilize. They may not go up by as much as people thought. They may not go down too much either. They might simply stabilize at around this level. Now, the reason for that is simply because as the price of silver goes up or down let's say the price of silver goes up, the margin requirement will go up. If the price of silver goes down, the margin requirement will decrease. So net, this could just cause silver prices to stabilize. However, of course, as we know, the CME are going to launch a 100-ounce silver futures contract in February, which could create some more volatility. However, none of us have a crystal ball, but this explains what has been going on. So, will this bullish trend last? It's anyone's guess, really. None of us have a crystal ball, and the price of silver could do anything. But if the CME Group continue to increase the margin requirements to 10%, to 12%, then it will eventually create downward pressure on silver prices.